Hi everyone, my name is Matt and welcome to another video by Stock Trades. Today we're going to be looking at dividend stocks, but not just any stock. We're going to be looking at Canadian dividend aristocrats which have been raising the dividend despite the current pandemic. For those of you who are unaware, Canadian dividend aristocrats are companies which have raised the dividend for at least 5 consecutive years. It's an important distinction to make. In the US, aristocrats have streaks of 25 years or longer. In Canada, you only need to achieve 5 consecutive years of dividend growth to be considered an aristocrat. So with that being said, let's get to it. Before we get into the good news, let's take a step back and look at the entire dividend landscape. Since the pandemic began, companies have been laser focused on preserving cash. This means that there has been a high degree of dividend cuts or dividend suspensions on the TSX. In fact, I believe the pace is unprecedented. Having gone through the financial crisis, I can't remember this many companies cutting or suspending the dividend. As of filming, there are approximately 75 companies on the TSX which have either cut or suspended the dividend. Not only that, Canadian dividend aristocrats, which are typically reliable income payers, are also cutting the dividend. There are approximately 12 right now which have cut or suspended the dividend. Case in point, one of the most reliable energy companies in the world, Suncor, recently cut the dividend by 55%. With the cut, it effectively ends the company's 17-year dividend growth streak, and it will lose its status as a Canadian dividend aristocrat. As mentioned, there's approximately 12 now which have cut the dividend, approximately 75 companies overall. This is no small number. We expect these dividend cuts to continue. In fact, it would not surprise me if we reach 100 over the next month or so. The reality is, the current pandemic has made for a very uncertain economic landscape. This means companies are not sure what state they will be in financially come 6 months from now, or a year from now, or even 2 years from now in some cases. In fact, Air Canada came out and said that they may see negative revenue growth over the next 3 years. That's a fairly significant time frame. With respect to the dividends, conserving cash is at the top of everyone's list. They need to remain liquid in case the business doesn't rebound as quickly as they thought. This is why you are seeing several dividend cuts and dividend suspensions. This isn't necessarily a bad thing. In fact, it may be a sign of prudent management. However, it stings us as shareholders nonetheless, those who rely on steady and reliable income. Which brings me to our first stock, Franco Nevada. When it comes to income and reliability, there is no safer stock than Franco Nevada. Earlier this decade, the price of gold cratered and entered a multi-year bear market. Several gold producers cut the dividend. In fact, there was only one Canadian dividend aristocrat left standing, and that was Franco Nevada. To this day, it still remains the only TSX listed precious metals stock that is a Canadian dividend aristocrat. No other company has achieved 5 or more consecutive years of dividend growth. That's a pretty impressive track record. Despite a prolonged bear market, Franco Nevada's share price is actually up by approximately 600% over the past decade. In 2020, it is up an additional 60% or so, far outpacing the TSX index and outpacing the TSX Global Gold Index. When it comes to the dividend, Franco Nevada has a 12-year dividend growth streak. Over this period, it has averaged approximately 5% annual dividend growth. This is not outstanding, however, it is consistent and reliable income. And as a dividend investor, this is something that I look for. The company's payout ratio right now is at approximately 40%. This means that the dividend is safe and it is stable. The company is probably holding back on raising the dividend by more because in recent years it has diversified into oil. We all know what the prices of oil are right now. Oil accounts for approximately 15 or so % of company revenue. So, unfortunately, this is holding it back a little bit. However, it is still a very, very reliable dividend growth stock. Since the company's IPO, it has returned approximately $1.3 billion in dividends to shareholders. Even though its yield may not look all that attractive, it has a yield on cost of approximately 7% since its IPO. This means that the dividend is growing and its share price is growing as well. On May 7th, the company raised the dividend by 4%, effectively extending its dividend growth streak to 13 years. Although you may not be attracted by its yield, Franco Nevada is one of the best-in-class gold stocks. We've touched on it in our top gold stocks of the year video, which you can check out on our channel. And we believe as a streamer, it is well positioned to raise dividends in a gold bull and bear market. Franco Nevada has a history to prove it. They are more reliable than producers and generate consistent and reliable cash flows. Next, let's talk about Alimentation Couche-Tard. Alimentation has a rock-solid 10-year dividend growth rate. Actually, make that 11, because the company raised dividends by 12% on May 7th. Now, this doesn't mean a dividend cut is not in its future, but as of right now, it is on pace for its 11th consecutive year of dividend growth. Is the dividend safe? Absolutely. The company has over $4 billion in liquidity, more than enough to navigate the current financial crisis. Not only that, it has a payout ratio of only 10%. This is one of the lowest payout ratios among all Canadian aristocrats. You might be asking yourself, why a company like Alimentation Couche-Tard, which operates in an industry that has been significantly impacted by the COVID-19 pandemic, might be raising the dividend at a time like this? The company recently walked away from an $8.8 billion deal to acquire Caltex Australia. By walking away from this deal, the company essentially conserved cash. Although Alimentation did indicate it may revisit the acquisition at a later date, at this point in time, it felt it was more prudent to walk away from such a big deal. I think this is one of the main reasons why the company was able to raise the dividend this time around. Had the company continued to pursue Caltex Australia, I am doubtful that the company would have raised the dividend. In fact, Alimentation has skipped raising the dividends because of purchases in the past. So I think this is why the company made the move this time around. In terms of looking at Alimentation as an investment, the company has been one of the best growth stocks on the TSX. Income aside, the company's share price has grown by approximately 1,220% over the past decade. That is an impressive rate and has made several shareholders very wealthy. Alimentation Couche-Tard may not look like an attractive income stock, but there is no question that it makes for an excellent investment choice for investors. The third and final aristocrat, which has been raising the dividend in the midst of a pandemic, is Algonquin Power and Utilities. This is a company that we have brought to your attention several times before. It is a leading utility and renewable energy company. We like it for several reasons. We like it for growth, and we like it for income. The company currently yields approximately 4.5%, and it now has a decade's worth of dividend growth behind it. Over the company's dividend growth streak, it has raised dividends by 10% annually. It is also the same dividend growth rate which it is targeting through 2022. This is what we like about Algonquin. Not only has it proven to be a reliable income stock, it also provides investors with insights and targets. Not many companies provide a targeted dividend growth rate, and not many have a targeted dividend growth rate in the double digits. Algonquin is delivering, and it is proving to be a very reliable income stock. The company's payout ratio is only approximately 40%, which for a utility is actually quite low. Therefore, we have no concerns with the company achieving 10% dividend growth through 2022. In 2020, the company's stock has been middling around the 2% range. It hasn't been an outstanding stock, but it is far outpacing the TSX index. Over the past decade, a $10,000 investment in the company would be worth approximately $50,000 today. Not a bad return for a utility company which is known for providing stable and reliable income. That is the beauty about an investment in Algonquin. Not only is Algonquin an attractive income stock, but it is also one of the fastest growing utilities on the TSX index. Analysts expect that the company is going to grow earnings and revenues by approximately 15% over the next couple of years. Considering the company is only trading at 19 times forward earnings, we'd consider the company to be trading at attractive valuations. Income, value, and growth. Algonquin provides a little bit of something for everyone. The pace of recent dividend cuts and suspensions has been unnerving. This is especially true for those whose investment strategy is centered around dividend growth. The entire premise is to increase and build your income and see that income grow year over year. Franco Nevada, Alimentation Couche-Tard, and Algonquin Power and Utilities provide dividend growth investors with some hope. It's not all doom and gloom. There are certain companies who are well positioned to raise and continue raising dividends well into the future. If you're interested, I am keeping track of all the dividend cuts and suspensions that have been taking place since the start of this pandemic. We'll put a link in the description below. Check it out. As mentioned previously, there's approximately 75 companies. I'm going to continue updating this on a daily basis as soon as I'm made aware that a company has either cut or suspended a dividend. In the meantime, take solace. Dividend growth is still an excellent investment strategy. Please let us know in the comments, what is your favorite TSX dividend growth stock? As always, please like and subscribe to our channel for more great Canadian content. Till next time.